Second flavor of IRAs is what we call a non-deductible IRA.
Right.
That's the same thing as the regular IRA, except you don't get a deduction for the money going in.
Right.
And the reason why you would do that is if your income is too high for the traditional IRA, then that's not allowed to you. You have to do the non-deductible IRA. So I may not get a deduction for the $5,000 that I put in, but let's say it grows over my lifetime to $50,000.
Okay.
When I take out the 50, I'm taxed on 45,000. Right, the 50 it's grown to, but I've already paid tax on that original 5.
I see.
Okay, so non-deductible IRAs are still a great tool because you're deferring that income, you're saving.
Now,
but
how much income are you looking at when you're getting into the non-deductible IRA?
It's still 5,000. The amount.
But what income bracket is one in to get the non-deductible IRA?
Well, the question you can always contribute to an IRA.
Right.
Whether it's deductible or non-deductible. What's going to make a difference is if your income is over a certain point.
That's what I want to know.
Okay. It varies based on filing status.
Yes.
It's
believe
about
it.
110,000
Okay.
joint return. Don't quote me on that, but it's in that
And
vicinity.
a single?
I don't. It's something lower than that.
Okay.
It's somewhere in the
so
75
anything over
range.
that, then
Yes.
you qualify for a non-deductible
Correct.
IRA?
Yes.
Okay.
Everybody can do a non-deductible IRA,
Right.
regardless of how much money you make or whether you're covered by an employer's plan. So it grows. Now, the key with a non-deductible IRA is you have to keep track of those contributions you make because when you take the money out, you don't want to be taxed on it again.
Right.
And there's actually a form you attach to your tax return, Form 8606, where you actually keep track of those non-deductible contributions.
Okay.
Okay?
Is there any way, there's a central point because let's say you have 3-4 IRA accounts and somewhere down the road you've forgotten, you started out when you were like 15 or 20 years old. And now you don't know. Is there any way if you just pull in your social security number, it'll pop up?
At this point, there's not.
Okay.
At this point, the burden's really on the taxpayer to keep track of in our firm, if you ever make a non-deductible IRA contribution, you have that form. That form will be attached to every tax return that we prepare.
I see.
Because we believe that, you really it's important to keep track of that.
I
Okay?
see.
So that's the non-deductible IRA. So now let's talk about the Roth, which is very popular.
Right.
Roth IRA, you put the money in, you don't get a tax deduction. Okay? But when the money comes out, there's no tax at all. Okay? Most people like Roths because of that reason. The money is never going to be taxed. There are income limits as well as to whether you can put money into a Roth IRA. They're generally a little bit higher than the difference between a deductible and non-deductible IRA, and they vary based on your filing status. But if your income is low enough, put money into a Roth IRA, it's going to grow tax-free. It's generally a good thing.
And what if you forgot, was it a Roth IRA or was it a traditional IRA?
Well, that won't be hard to forget because that's designated by the investment advisor that you have it
Okay.
with. So that's going to be very clear whether
and
it's a
plus
Roth.
you get a quarterly report.
Yeah, you'll get an annual statement, and actually they actually send statements to the IRS. So.
Oh, they do it directly.
So that's not going to get confused whether it's a Roth or not a Roth IRA.
But do you have to put it in your tax returns? Any of the IRAs that you've taken out, or you don't
Well,
have to?
when you take money out,
But not when you're.
when you're putting money in,
Yes.
only with the non-deductible IRA, because
Right,
you have to
okay.
show the IRS what your basis is, what that non-deductible piece is, so you can keep track of it. So Roth IRAs, I think, are wonderful animals because they do grow tax-free. Now, what we often see is clients where they may have their own business and their income may be too high for a Roth IRA.
Right.
But what they'll do is, if it's reasonable for them to hire their kids for summer work, helping out, whatever reason, if the kids can earn
Right.
$5,000, you give them a W-2.
Right.
There's nothing stopping the parent from making a gift to the kid and funding a Roth IRA on their behalf. Okay? So if you can put $5,000 for a few years in a
For
kid
each child? Let's
for
say
each
you got
child,
3
as
kids.
long as they're working in the business.
Oh, they have to be part of the business.
Well, they have to have earned income. It doesn't have to be your business. They could be earning money babysitting.
Right. So
Okay?
then you give them a W-2.
Then they get a W-2. They pay tax on that income.
But you're contributing $5,000 per child.
Correct.
Every year, if you can
If you
afford it.
can, yes. So if you look at the tables of putting $5,000 away for a few years to a kid who's maybe 10 years old,
Right.
ages 10 to 15, it grows, especially on a Roth IRA, it grows to an astronomical number
Right.
when that kid will
So the
reach
kid gets a
retirement.
W-2 every year.
Correct. But the kids at a relatively low tax rate, so the tax expense of it is really not too high.
So it has to be a working kid. I mean, you
Has to be,
can't
yes.
give a kid who's 10-year-old. So it has to be like 18.
All IRAs that we're talking about, you have to have earned income.
Right.
whether it's on a W-2 or whether it's self-employment income.
Right.
Now, nothing to, if, you know, like I said, if a kid is earning money babysitting, they can declare that income on their tax return and use that as a basis to make a Roth IRA contribution.
Right.
So that's a tool that we see a lot of parents do for their kids. It's a wonderful gift you can give to your children to set up a Roth IRA.
Now, can you convert your non-traditional IRA
Yes.
to a Roth IRA?
Yes, so that's another tool that we see a lot of, because ironically, there's an income limit to contributing to a Roth IRA, but there's no income limit to taking a non-deductible IRA and converting it to a Roth.
I see.
So anybody, no matter how much your income is, you can make a non-deductible IRA contribution. So I can contribute $5,000 to an IRA today, and next year, let's say it grows from $5,000 to $6,000.
Yeah.
Next year, I can take that non-deductible IRA and I can convert it to a Roth.
Right.
So when I do that, it's as if I have to pay tax on that gain. So when the day I convert, it's worth $6,000, but I've already paid as a non-deductible contribution $5,000. So I'm going to pay tax on $1,000, but now I've got $6,000 into a Roth IRA, and now it's going to grow for the rest of my lifetime tax-free. So that's another tool that many people do to get money into a Roth IRA if their income is too high otherwise.
Is it good to, and is it advisable to have all those IRA contributions to one single entity or one company so that, they keep a track of it?
Well, you're actually getting into a different area, which is the Roth IRA is what's the tax vehicle that it's going to be in. The question is how are you going to invest it, and how are you going to keep
Right.
track of it? And most of the major fund companies will give you a wide variety of investment choices. So if you find the right fund company or the right investment advisor, I do like simplicity. I do like keeping everything under one umbrella. But if you're with the right advisor, you can get enough diversity
I see.
to be diverse, because depending on how far you are from retirement will dictate how this money is invested.
Right. Now, let's talk about capital gains and taxes
Yes.
and assets and losses.
Yes. It's so good to be thinking about this now instead of the end of the year, because capital gains capital losses. If I have a loss in a stock and I sell it and it's gone down in value, I have a capital loss. That loss really can only offset capital, with one exception, can only offset capital gains. So the trick is to make sure that my capital gains and losses have offset each other.
Right.
And that's an exercise we typically do at the end of the year, but if you can be thinking about that in advance, you're going to be ahead of the game. So if you have stock that's gone up in value and you've decided for investment purposes this is the right time to sell it, you have what we call a realized gain. That gain you've cashed in. So what you want to do is you want to look for losses that have gone down in value, that it may be the right time to sell and to what we call realize that loss, so the two will offset.
Right.
The worst thing you can have is you can have a realized gain where you've actually sold stock at a gain,
Right.
but you have a stock that's gone down in value, but you haven't sold it because now that loss is not going to offset that
Right.
gain. So anytime you're thinking about selling stock at gain or loss, think about what's going to be my other side. Do I have anything that I can use to offset it? Because certainly by the end of the year, you're really going to want to try very hard to offset it so you don't pay tax on a net capital gain.
Right.
And along with capital gains, an important aspect for anybody that has a business or has rental property is the ability to, if you sell that property at a gain, to do something called what we call a like-kind exchange.
1031.
1031, exactly. So I have rental property, it's gone up in value, I may have a $200,000 gain, but I know in my mind that I'm going to reinvest, I'm going to buy another rental property because I think the market is good.
Right.
Okay? It's too complicated for this discussion, but if I know that I'm going to reinvest that gain,
Right.
I can actually go to my attorney or my accountant and set up what we call a 1031 like-kind exchange so that the gain is deferred, okay? But it's absolutely critical that it be set up in advance. Once you get to the closing table and you've received the money, it's too late. So if it's
So it has to be done before the
Has to
closing,
be done-
before you realize the gain.
yes, absolutely, because the minute you touch the money, you can't take advantage of that provision.
I see.
Okay, so if you're going to sell something at a gain and you're going to reinvest in something that's similar,